Okay, welcome everybody. It's just gone 10 o'clock Central. My name's Lee Harris from Emoji Trading, and this is the third of 5 webinars which we're running this month, introducing our order flow suite version 3. To answer the question that comes up all the time, yes, the webinar is being recorded. We will make a recording available of this by close of play on Monday, and it will be posted at our website as well as on our Vimeo and YouTube channels. You can ask questions as we go through. I'll try and deal with them if they're relevant at the point, and certainly we'll do a wrap up at the end. So today, what we're going to cover is how we can use indicators in the order flow suite to identify aggressive traders. This is something that people really are, well, it's a popular way of visualizing order flow. It's quite apparent if lots of marked orders come into the market, then people are interested in why is there all this buying. But today we're going to go into some subtleties around aggression, including looking at different ways of identifying aggression, not only through imbalances, and also seeing how a lack of volume can also give us clues about aggression. I'll go into some detail of the mechanics behind that. At the end of today's webinar, we've really covered off all of the fundamental features at a basic level within the order flow suite. We started a couple of weeks ago introducing Scalper Pro, one of our most powerful indicators that's great for identifying reversals. And we also showed unfinished business, and we looked at the emoji zones, so how we can track the progression of order flow events during the course of the market, and also the new advanced lookback filter, so that we can detach our charts from time and price in order to filter out events. So we're introducing those concepts during the first webinar. Last week's webinar, we looked at Absorption Pro. Absorption is one of my favorite things to utilize in order flow analysis. And we had a quick look at our advanced pullback analysis. That's quite deep. We'll be going into that more next week. Today's relatively simple. We're looking at some relatively simple indicators. We'll be looking at the emoji zones, maybe a bit of look back filtering as well. But if you've used version 2 of the order flow suite, there's going to be nothing here that is conceptually that challenging. It's more a walkthrough of, here are some of the new features, here are some parameters that you can change. From next week, we get much deeper. We go into some advanced feature deep dive. So we've got a bit of a breather this week, maybe as a recap of some stuff that you know. So what we'll cover today are edge zones, our main indicator that highlights aggression, Delta Scalper Pro, which looks at how we can identify aggression on a bar-to-bar basis, and then also small prints, which we can use to identify exhaustion. We'll cover that very briefly, but as today's focus is all about aggression, we'll see how we can utilize small prints to use lack of volume as a clue to the presence of aggressive trading. Before we dive into edge zones, I want to give a quick history lesson. Order Flow Suite version 3, as well as lots of new advanced features and re-architecting what we do, we consolidated about 30 indicators into 14. We had a bunch of kind of component indicators in Order Flow Suite version 2, including stacked imbalances where we could highlight 2, 3 or more imbalances on top of each other at consecutive price levels. Massive imbalance. We had lots of component indicators that looked at certain facets of order flow. And we would often get the question of what indicator should I use? Now, we can't tell you what to use. We can tell you this indicator will identify this condition. And here are some ways that you can look to act upon these conditions. But what became apparent is rather than having component indicators that did individual things, we should really be concentrating on the themes of order flow: aggression, absorption, exhaustion. And if there were multiple ways of identifying those conditions, if we could logically combine those into a single larger indicator, then that's what we should do, which is how we've come down to a smaller set of more powerful indicators. Now, edge zones was a brand that came into being a couple of years ago through the work of Anthony Drager with Market Delta. At the time when edge zones were introduced on the Market Delta platform, which must be, let me think, probably late 2017 time, that sounds about right. The event that Market Delta edge zones were looking for was a combination of what we would call a massive imbalance. So we're looking for a bid-ask imbalance where volume and delta meets certain thresholds, and also the diagonal bid-ask percentage, so ask divided by bid or bid divided by ask, was above a certain threshold. And that would kick off the presence of an edge zone. So we would see that as a massive imbalance. It's an imbalance that meets some volume or some percentage diagonal comparison criteria. And then the zone part of things came into being because the Market Delta software would project out that level until price traded above or below it. If it was a buying imbalance, then when price closed below the future point, the projection would stop. We had most of those components on Sierra chart in the order flow suite at that time. So between stacked imbalance, massive imbalance, we had the underlying calculations to find these events, and we put a slightly different twist on the edge zones into an indicator called edge levels, but we introduced that as well as our emoji zones. So the historic Market Delta visualization, once a level was found, was here's a colored band, and when we trade on the wrong side of it, the band stops. We introduced emoji zones around that time, which considered order flow. So rather than just stopping based on price action, we would consider how price has traded around or through the particular level that's been identified historically by the supply-demand event, and then allow that level to be painted as new demand or continuing demand or exhausted demand, and then reverse roles into new supply that was demand that's potentially becoming continuing supply or exhausted supply. So rather than just relying on price action from your chart, which as we know is arbitrary, the market doesn't care about the chart you're looking at, we considered the volume in terms of how we projected forward. Now let's fast forward a couple of years. Market Delta unfortunately declared Chapter 7 bankruptcy last year for various reasons. And after some work I did with Anthony last year, we started collaborating on a formal implementation of edge zones for Sierra chart. He was looking for the possibility of a route away from Market Delta for members of his edge trading group with whom we partner. And it seems that Sierra chart combined with our indicator provides a good platform in order to do that. So we launched that indicator last year for Anthony's trading group. And I can see some familiar names in the trading group on the webinar today. Hello. But now with our version 2, version 3 consolidation, we have rolled edge zones into the main order flow suite, replacing stacked imbalance, massive imbalance, and edge levels. That's enough of the history lesson. That went on far longer than I expected. So let's start today and we'll take a look at edge zones. Just going to switch the screen across. Here we go. So here I've got a chart of ES. It's my preferred footprint layout where I've got bid-ask imbalance, I've got a delta profile, and I'm coloring the delta profile according to the delta that's there. I've also got some summary data sitting behind, sitting at the bottom of the chart so I can see the bar-to-bar delta, cumulative delta, etc. So let's put edge zones on this chart. And the way I'm going to do this, well, normally I could go studies, add custom study. But what we also do, we include some quick start study collections with the order flow suite. You can download these from our website, and they're present on the analysis menu. So what I can do is pick the edge zones up here, but before I do that, I'm going to change my footprint into the edge trading group style. So I can select this quick start template, EC basic footprint edge style. The plus sign means it's going to prompt me to clear the existing studies on the chart, which I'll do. So now I've got a footprint. I personally like to have the chart dome on as well. And where are we? This is an 8-tick reversal chart. I don't have open close on the candles. I've put a bit of context here. But, you know, here's pretty much how the edge trading group starts to run its room. And I could put a picture of my brothers up and talk about bird in the sky, rotation for location, and all that kind of thing. My impression of Anthony is as bad as his of me, but this should look quite familiar. Now what I can do is go to the analysis menu, and I can pick one of the preset edge zone study collections. I'm going to start with what I call MD style, MD market delta style. I'm not going to clear the studies. I want to keep the numbers bars on the chart. So now what I've got is really the classic market delta style edge zones. We have got the indicator set up on this preset so that we're looking for a 600% bid-ask imbalance, and we are looking to highlight zones with 2 adjacent levels. You can change this to anything you want. These input settings are something we went through in webinar 1 for price rejector. They are common to all indicators where we are looking at bid-ask imbalances. I'll explain them once more now. The minimum diagonal bid-ask imbalance is how we're calculating imbalances. So here, 68 divided by 1 is 680%. This qualifies. 132 divided by 15 is, come on brain, you can do the maths. Anyway, it qualifies. Compare zero diagonal bid-ask imbalance. What we're doing here is saying we do not want to highlight imbalances if there's a 0 on the other side. So if we look at this buy imbalance here, 38 versus 0, although the numbers bars have picked it up, edge zones wouldn't consider this as an imbalance. We do this to filter out noise, basically. Personally, I use small prints to highlight zeros. Minimum volume is how much volume we want to see within the imbalance side. So if I set this to 100, this imbalance of 68 contracts should disappear, as it does. So what we're saying here is the minimum amount of trading, aggressive trading, market orders that we actually want within the imbalance volume in order to count it as an imbalance. And one of the ways you can utilize this is maybe have the same parameters on the chart, but perhaps you don't want to consider imbalances that occur overnight on low volume. If you've got 17 contracts versus 1 overnight on ES, are you really that concerned about tracking that as an imbalance? Then minimum bid-ask delta is a similar input, but rather than considering the actual volume on the imbalance side, we're looking at the diagonal delta. So here's 68 minus 1. That would be a different delta of 67. So if I want there to be at least 100 more contracts which were sold and bought, or bought and sold, I would set that value in minimum bid-ask delta. In historic market delta terms, that was an input on CQG called min diff. But you can see we can really now start to fine-tune the volume parameters here, so that as well as looking at the relationship between the trading, you can put some absolutes in here to filter down spurious events. And then finally, we can set how many levels we want. So if I only want 1 level, I'm going to highlight lots more imbalances. We're not seeing that particularly on this visualization. Oh, it's still calculating. This is our historic stacked imbalance functionality. We had a specific indicator highlighting stacked imbalances. So that's how you can implement stacked imbalance within edge zones. It's utilizing this minimum adjacent levels. For me, I want to see as few events as possible. Partly because you can see my machine is calculating as I've given it very loose parameters. Look at all these zones that come up. I can't trade off a chart that's got all these zones. It's too much information. Yeah, this is too much noise. It's not the fastest chart in the world at tick reversal, but do I really need to extend every 600% imbalance? Doesn't make sense. So if I put 2, we start to get much more significant information. So let's look at how these are visualizing themselves. Here's a 2-level edge zone. We've got 2 qualifying sell imbalances. this is the event that kicks off our drawing of what we refer to as emoji zone. So it's an edge zone event, 2 levels stacked in balance that meets our criteria. It represents supply, so it's red. Now it continues red until such point as price closes above it. Then it changes green. So we're using the market delta style of drawing zones. The way in which we're controlling this is through our emoji zone visualization. I'm using emoji zone dynamic mode. I could just have fixed projection, in which case I'd only be alerted about that through a certain number of bars, which I specify here. So 3 bars is default. But in dynamic mode, I'm saying evaluate only on price. So rather than considering the order flow as we trade through here, I will only change state if I close above supply or below demand. If I don't want to see the reversal of the state, I turn that to no. And now what we've got is we've got a zone, and that zone will just disappear until such point as it disappears at the point we trade above it. So this is, let me think, this is 12 months, 18 months ago kind of technology, and the visualization in market delta. If we want to have a bit more information though, we can start to use dynamic mode using order flow evaluation. So if I change price to order flow and hit apply, now, depending upon how we trade through these zones, we indicate whether the supply is continuing, which it isn't in this case. If it was continuing, it would be a more transparent red, or exhausted. If it's exhausted, it's likely to break, which sure enough it does. So let's just scroll back some examples of multiple states. There's a good one. So here we've got big up candle. We must have closed below this one in order for it to stop. We're not doing role reversal yet. So we have new demand here. The way this candle traded through the new demand told us the demand was continuing. The way this candle traded told us that the demand was exhausting. Sure enough, we go below it. So we can use the order flow analysis as part of dynamic mode to keep track of the quality of these states. Now, if you want, a basic approach to trading, you can just say, well, if I've got a new event, I will trade the retracement of it. So I know I've got demand here. My risk is quite well defined in terms of the level below where this new demand presented itself. We could trade the first test. So, I'm happy to go long 1 tick ahead of it, 1 tick inside. I'll get out if we go below this. I've got relatively low risk. And actually, where's the logical exit if I'm just looking as aggression? Well, where's supply above me? You need to scroll a long way on that. There's exhausted supply there, but you get the idea. By using order flow evaluation within the emoji zone visualization, we can get a sense of the quality of these levels that are presenting themselves. Here's a great example that this new supply has held, it's continuing, we trade to the tick there. Can only be a coincidence. As the more and more examples, then, the more examples I find, the more coincidental it gets. Let's add the role reversal into the indicator just so we can have a quick walkthrough of what goes on there. So if I say dynamic mode state reversal, yes. What we're now doing is when a level breaks, as we can see here, we change demand into supply and vice versa. Let's see if we can find one that goes full cycle. So we have new demand, it exhausted. Okay, we're trading above it, but it's telling us when we get down here, it's likely to break. Sure enough, it breaks pretty decisively, although we didn't close below it. Here we close below it, it becomes supply. Definitely becomes supply. So the role reversal, for me, certainly adds some value. The trading is about identifying levels, trading between those levels, seeing what happens on the next level. So Christine has asked, do I recommend using order flow and not price only? Yes. I want as much qualitative information about what's happening within the volume as I can get. I don't want lots of levels identifying themselves. I only want to see significant supply and demand events. So I don't want to see every imbalance. I want to see the most important aggressive trading entering the market. But I do want to understand how the market is reacting when these levels are retrading. I want to know whether the aggressive traders who have kicked off this demand or supply are defending their position, whether there's enough other weight coming in at these levels. People have seen them, we're not the only ones, that they're maintaining themselves, or if they fail, I want to know whether demand will turn into supply and vice versa. So for me personally, I will always use dynamic mode with the order flow evaluation. And you can trade these in different ways. We can say if I've got a new level, then actually I will open on the retrace in the direction. Or we can also think that the first time this trade is unlikely to break, it also gives us a potential exit target. As I said in webinar 1, if we don't have a point to exit, then why on earth are we entering a trade? You can't evaluate your risk reward. So as well as these providing good pullback entry opportunities, you could also look at these the other way around and think, well, if I know I've got demand here, then it's a good place to sell to close. So if we have a reason to be short somewhere up here, and we think we're unlikely to break this new demand, let's get out. So we can use these as entries on retracements or exits and trade to them. But it's a great way of identifying levels and bouncing between them. So that really is a quick walkthrough of edge zones. It's in order flow terms, it's a relatively simple indicator. It's showing us visibility of aggressive market orders. The subtlety comes into how we can fine tune and filter this aggression. And we can do that through the absolute volume on the side of the imbalance or the bid-ask delta to understand the relative strength that's going on between both sides. But the real value comes from being able to track these levels over time and identify how the market is reacting to them. So that's edge zones. Let's now move on to the next indicator, which I want to talk through today. And that is going to be Delta Scalper Pro. Again, this is an enhancement of our previous version 2 Delta Scalper. Let's think about what Edge Zones is doing. Edge Zones is looking at specific bid-ask imbalances at individual price levels. Now, depending upon how you configure your chart and how much volume you're capturing within each candle, you may or may not see an imbalance at a particular price level. An 8-tick reversal chart is capturing a different slice of volume to a 10 range chart, or a 4-tick reversal, or a 5-minute or 30-minute. So you will not always see particular imbalances at particular prices when you have got different chart periods. And this is why, I mandate whatever chart type you're looking at is wrong. The market doesn't care. I'm a fan of getting as much volume in the chart as I possibly can. I want to read the volume. I prefer reading stuff vertically because it's the aggregation of volume over time at different price levels that allows me to build the picture of what's going on. And it's a more efficient use of screen space. If I run a 4-tick reversal chart, I can easily lose track of the big picture. Delta Scalper Pro takes this concept into account, because what Delta Scalper Pro is looking at is the relationship of delta between each bar, irrespective of the time period that we're looking at. So let's apply it to this chart. I'll just turn the chart back into style which I like to use, and we'll apply Delta Scalper Pro. Before we do, you can see I've got a summary of the delta of each candle sitting here. What we're doing with Delta Scalper Pro is we're comparing the delta of our current candle to the delta of the previous candle, and we're saying if this candle is X% higher or lower than the previous candle, combined with some filtering, then we've got aggression. So we consider the change in delta between candles. Now, that's relatively coarse because the delta is the aggregation of all the trading within the candle. But if we're looking either at significant swings in the delta, or if we have got a move going on and suddenly a lot of volume piles into that move, supporting the value of the move, we'll see it in the middle of the move, then it gives us a good sense that, okay, conditions have changed. What we also do, though, let's add it onto the chart. So I'm saying if I've got a 400% change in bar delta between bars, come back to the look back, then show me the delta scalper condition. I'm not going to do any visualization first of all. Let's just see where the arrows come so we can talk through condition and why it's happening. Okay, well, that one, my mental arithmetic works. The change in delta between negative 55 and positive 248 was more than 4 times what went on here. We had a net, 300 change in delta. So it was about 6 times change relative to that. Here, negative 132 versus negative 1, huge change. So we're showing on a bar-to-bar basis where we have got aggression coming in. That's fine, but the bar on its own is a bit coarse. As I said, this is just an aggregation of this arbitrary slice of volume which I've got in each candle. We get some nice clues from it, but it'd be great if we could actually pinpoint levels as well. So we can do that. What Delta Scalper Pro will do, if I turn on some emoji zone visualization, just for simplicity, I'll use fixed projection for now. What we now do is highlight the price range that caused the delta to change. So now, within this candle, which is an aggregation of trading over a time period, now we can see the range of prices where the delta really spikes up or spikes down. Now, we could try and catch this live, but actually we're much more interested that, okay, demand has come in this area on this candle. So now we know good areas where if we trade down to it, we can watch, is this demand going to maintain? So in our previous version, we couldn't track this historically. We painted the delta scalper condition in real time and we built out the zone. In version 3, we now track these zones since the beginning of your chart historically, so that you can really see where demand or supply has come in within the candle, so that you can start to pinpoint levels much more. As you would expect, we can turn these into cleverer emoji zones. We can use fixed projection, we can use dynamic mode. So you can start to use these levels in the same way as any other emoji indicator and have them as potential exit targets or entry to retracement and start to qualify what is going on when we revisit these levels. We also have our look back filter, which we went through in our first webinar. So maybe, well, you know what, you can use Delta Scalper in a couple of ways. It's interesting to see if we get demand coming in the middle of a move. Okay, we've got no filtering here, but here's a good example. We're moving up, moving up, moving up. Bam, we get lots more buying midpoint in the move. More people join in, or maybe maybe that was climactic buying. But you get the point. We can see it in the middle, or we can look to use it as a reversal indicator. And that's why we've got the advanced look back filter within here, so that we can do simple things. Let's look back across 5 bars to filter out. We only want to know about Delta Scalper at high, high, low, low over a particular number of bars. Or we can filter based upon contextual levels, session high, low, daily high, low. We can look back over a number of minutes or a rolling minutes period since the start of the session. This is something we'll go through in more detail again next week. But the idea being, let's imagine market profile where we're dividing the trading session into 30-minute windows. If I'm looking at an 8-tick reversal chart, I can actually say every turn of the half hour, reset what's high and reset what's low in order that I can use my faster chart as a window inside a slower chart without needing to look back at the slower chart. And that's really powerful. But now the next effect of this, I look back over an arbitrary number of bars. We are only going to show the conditions at higher highs, lower lows over a number of bars. So you can potentially start to use it as a reversal tool. So that's Delta Scalper Pro. Different take on how we identify aggression. If you are considering longer moves, then knowing that we can see where a bar has become more aggressive, that's a good thing. We can read that from the raw data. But actually being able to track the price range through which it has become aggressive gets really powerful, because then we can consider what we're looking for and how it will react when we revisit back at those price levels. So that's what the combination of Delta Scalper Pro and emoji zones, which are built in, of course, enables you to do. What we're now going to cover is how we identify aggression through a lack of volume. These are some of my more favorite approaches. I mentioned earlier, I like absorption. Absorption is about seeing the unseen. Everyone can see imbalances. People will see lots of market orders. I don't want to make my decisions based on what everyone else can see. In reality, if everyone else can see the same thing, then the smarter and bigger money is probably looking to be on the other side. Much more interesting to trade with what's harder to see, in my opinion. So the small print indicator allows us to identify aggression as a result of a lack of volume. Now, I put up a blog post on our website earlier this week that came about from an example in CL that I stumbled across a few weeks ago in a coaching session. And I'd recommend you go to our blog and have a read of this, because it was a really great example of small prints and stop runs. You've got the ability to read it yourself. I'm not going to go through it in massive detail, but we've got a nice walkthrough of reading the story of a situation that happened in the market that actually was triggered off by a small print, in fact, a zero print. But what was most visible, if we weren't adept at reading the raw volume, or if we weren't using any indicators to make life easier, what really stood out was this, which is a stop run. But by getting into the story of what happened during this particular period on CL, we can kind of do some detective work and actually identify it was this area here. I think it was 55.90, I think was the price. This was actually the start of the activity that most likely triggered the stop run and ended up giving us a really nice opportunity to trade down to the low of the day, the unfinished business, from somewhere in this area when we could see that this held actually with big absorption. But let's explain why lack of volume indicates aggression. Okay, here we've got a stop run. How do I know it's a stop run? Because nothing traded on the other side. And it's probably worth talking through this mechanic in a bit more detail. So stops are held at the exchange, but not visible in the order book. A stop order, when price trades, a stop converts into a market order. That market order, of course, consumes liquidity of limit orders that are already in the book. And this is why stop runs can occur. The clue is there was no opportunity for two-sided trade. That's why we see the zeros. So what's happened here is we got to the low of the day, wherever that was, 80 something. Yep. It's reasonable to assume that there will be stops clustered around the low of the day. Where they are, Don't know. It might be a 5-tick range, 10-tick range. But if you think back to your early days of trading and reading technical analysis books and chart patterns, the advice from 20, 30 years ago was, put your stop 2 ticks behind the low of the candle, the pattern, or this kind of thing. So you can kind of predict where stops are going to exist. If you're a large trader, as I've mentioned before, you need liquidity in order to trade your volume. Stops provide liquidity because they convert to market orders. So if we know where stops are likely to exist, we can take advantage of them. So how could somebody have been trying to take advantage of the presumption of the presence of stops here? Well, if I can trade enough size that I can eat all of the buy limit orders in the book here and force price down, so whatever's in the book here, I'm going to sell into it, sell into it, sell into it. And I'm going to keep selling until all these passive buyers disappear and move down a price level. And I'm going to keep selling again and keep selling again, keep selling again. Some point, I hit a price level where there's a stop. The stops that are sitting here convert to market orders. The total volume here, with the zeros on the side, is about 450 contracts, I think 452 contracts. Now, it could have been stops here for 200, another 200 below it. It could have been one for 450. We don't know, don't particularly care. But if I'm the guy who can push price down to the point where these stops trade, then these stops are working in my favor, sweeping out the liquidity in the order book here. They consume all of the buy limits, and I go down another 5 or 6 ticks, at which point I'm really happy to buy back the move that I probably started off here. So if we see this, we know somebody has kind of taken a view that there could be stops, that liquidity could favor them. What we're interested in seeing after a stop run is, does the move continue down, or does the market consolidate a bit and potentially go back the way it came? We want to know if there's follow through on this. But when you see this pattern, it gets quite interesting in terms of identifying the cause. And for me, I then want to look back. This hasn't happened randomly. I'm interested in looking back to see, did something else trigger it off? In this particular example, there was a 0 print within this candle. Okay, it's 10 range chart, so it's not especially slow. We will get 0 print, certainly on something like CL. But after we churned around from this shock in the market of the stocks, look where we got to. So I would take the view with my detective work, whoever kicked this off here, they've made some money, it's come back, but our Absorption Pro has shown us that we've got the maximum amount of aggressive buying here being absorbed at the same price as where this activity kicked off. So for me, that's kind of a nice clue, especially when I've got unfinished business below me, telling me that this low was not low enough to run out of sellers. So by reading the story, initially flagged by, okay, there's 0 print, oh, look what that 0 print did. We've gone back up here. Okay, this price looks familiar. Now I feel quite confident about a short trade because this guy is going to defend me. So my risk is known, my reward is known. I've got a really favorable risk-reward ratio that's made up from a very logical story that's gone on in the market. But the clue has first of all come from a lack of volume. Okay, had some imbalances here. Even without the imbalances, it's the zeros that stand out for me. So let's have a look at some of the things we can do with small prints indicator, and I'll give you some ideas on ways in which to use it. Okay, so we are back in our live ES chart. If I add small prints onto this chart, and we'll go through the settings. Okay. We've got our familiar set of imbalance inputs. We use that for what historically we called a thin spot. I'll come back to that in a moment. But we've got our imbalance inputs. We have our price reversal filter. So if we're looking for demand, do we want the bar to be confirming the movement of demand, or are we happy to see demand in a down bar as well, and vice versa? Another level of filtering. Here are our key inputs, though, for the modes which we're going to look at. Let's deal with the first one. This has nothing to do with aggression, but we might as well do it because it's there first. This is our historic single print at extreme indicator, sign of exhaustion. So what I'll do here is I'll set this up just with a fixed projection, hit apply, and we're not showing anything, so I haven't put a volume filter in, which is a bit silly. What I want to do is identify small prints at the bar extreme and what's the maximum volume that I'll allow through the filter. So if I say I want to see a single print at extreme and have this highlighted, then when we are at when we've got single print at the extreme of the bar, we highlight it and it turns into an emoji zone, which we've covered off. This is our historic single print at extreme. The subtlety in the enhancement now within version 3 is you can decide how small is small. Historically, we want small prints. You could say I only want to see 5, or maybe you're trading Bitcoin, I only want to see 10,000. So you've got a bit more control. But this is exhaustion. We're not going to concentrate on this right now. Here's where we can use lack of volume. So identify 0 print in the bar body. Let's say yes. And let's see what comes up. So here's a 0 print. What we'll do, you can start to see how these levels act pretty well, but they'll also roll reverse. That one would roll reverse. So we had aggression coming in. We closed down through it. Look where we trade back up to. On ES, it gets pretty interesting. Intraday, on pretty much any chart period, you'll find 0 prints appear. Generally, they fill. But if you're quick, you can sometimes, so here's a down bar with 0 print here. We'll paint this live to really highlight it to you. You can throw in a sell limit just ahead of it and front run it. I've been playing with an algo I wrote actually on micro ES, where I'm reading the volume on full size ES, but I front run using micro ES. And knowing that we'll generally trade back up and fill the gap, I'll use this to scale in to a swing position on ES using the micros. And I'll really load up because this can happen many times, and I let the computer do it because I can't always act that quickly or I'm not looking at the screen. But when it doesn't fill, it becomes quite a significant level. It means that we plowed through this level, there wasn't two-sided trade, and you can see how these tend to hold. I'm going to go through this in more detail next week on a pretty advanced way of using it, but it gets interesting. If we take a longer term chart, here's a 30-minute chart, let's put the same configuration of the indicator on here. So I want to find 0 prints in the bar body, and I'm going to visualize it now using dynamic mode. And we'll do order flow evaluation. No look backs. My premise here is that on a 30-minute chart, if we trade through a level and we don't retrace it, then on a relatively thick market like ES, this is significant. We've had aggression. And you can build some nice trading approaches just with this one indicator, because a 0 print on a slow chart is a relatively odd occurrence. And I want to find these odd occurrences. So we've got new demand that kicked off here. Okay, it's overnight session. But look, we hold that twice on this 30-minute chart. We trade through here. It trades in a way that tells us this demand's exhausted. We plow straight through it and the one below it. Let's see what's happened up here. Okay, we have broken that one. That one says it's held, and I'm probably, okay, when we bust through it, it's overnight. Let's have a look at some others just to see. Okay, big amount of aggression coming in here. We strip away 2 levels. Look how it holds. So what I'm going to do next week is go through a really advanced way, a smart way of using this on daily charts to find some interesting levels. But you can see how a zero print in the body of the bar, it gives us a pretty good level either to use as an entry level on a retrace, or if we had some reason to be short. Okay, we've got unfinished business up there. That's not really a reason to be short. But you can see how the new demand or new supply can act quite effectively as a stopping point on the way back down. So that is the zero print in bar body. Small print in bar body is similar. We ignore zeros. What we use is actually these thresholds here. So if I say identify small print in the bar body, I can say how much volume will I let through my filter. Oh, okay, data feed's broken. Let's say I want to see any small print which is 5 contracts or less. We're going to get some more levels. You see here, we're not identifying the zeros, we're identifying this 5. So it's a way of showing where we've got relatively low volume. Same principle as zero print, but a little bit finer control. Once again, we're using a lack of volume to tell us that there was aggression on the other side. Now, why is this important? It's because whatever bid-ask imbalance we do, lots of people use 400, some use 600, some use 300. You know what? That multiple is arbitrary. So we don't know what's right. We've actually got some clever development underway to get away from the idea of these arbitrary levels. That's something we're going to introduce hopefully before the year is out. But we can't argue with a lack of size as showing opposing aggression. So here, yeah, of course that was aggressive. But rather than by searching on is this X% larger, if we say how small is the opposing side to what's happening, we can find some levels that potentially we'd otherwise miss. We can find this lack of volume both through the absolute volume, so there we're allowing 5 contracts or less through, or we can say what's the percentage of that volume compared to the size of the whole bar. That's what we historically called a thin spot. So what I can say here is if we have got volume that is only representing 0.5% of the volume on that side, and we also look at an imbalance, you know, by definition there should be an imbalance of something on the other side, then we'll paint the thin spot. So 0.5% was maybe a little bit too loose, but you can see we're picking up levels here. Okay, it's a lot of volume in this candle, but we're showing any price level where the volume that traded on the side represented less than 0.5% of the total volume in the bar. So Chuck has identified and zero prints above it. Yeah, absolutely. And look at all these imbalances. Big volume came in here. We can identify this aggression in many ways, none of which are right. You know, what is right is there's aggression, and we're interested in seeing where it held. If we're only using the imbalances, okay, we trade to the tick. If we use small print, then we get down to, okay, we can see that's really where the activity kicks off. So you've got different ways of visualizing aggression, excuse me, which has been identified through a lack of volume. So we're looking for what hasn't happened rather than looking for what has happened. And much like with my approach to absorption, I would suggest you give some thought and explore using the indicators how you can use the lack of visibility of something. That's how the Baskervilles. The lack of visibility of a condition as a heads up to something important. It's a lot more subtle and I think a lot more powerful. We don't want to act on the same things that everybody can see, because then we're probably going to fall into the traps laid by other people that are seeing the same thing, knowing what the herd are going to do, and bang, suddenly big passive volume on the other side traps us. Much more subtle and interesting to be evaluating what people generally are not seeing and be acting on that. So we can apply that to aggression through small prints indicator, as well as to the actions of passive traders using Absorption Pro, which we covered last week. So what we have walked through in the past hour or so, just coming up to the hour, is how we can use edge zones to highlight aggression intrabar at specific price levels using bid-ask imbalances and some subtle filtering using the absolute volume, the delta volume. Then how we can take account of the fact that our bar period is arbitrary. So we care about aggression between bars. That's what Delta Scalper Pro does. If you want to know that the candle has had a change of 4 times as much buying than the previous candle, then we can use that fact to highlight the price levels where this aggression occurs. And then the most sophisticated way of looking at aggression is through lack of volume, for which we can use the small print indicator. So that pretty much wraps up today's webinar. I said it was a simpler webinar than last week. We've gone through 3 indicators, all of which were present in version 2. They've got some more powerful features now in version 3. I'll deal with some questions. Harvey, I think, what's the best way to configure Delta Scalper Pro if using lower time frame charts, e.g. 30 seconds? Well, I am really not an advocate of these fast charts. For me, a 10 range or a 8 tick reversal chart is a fast chart. I can't relate that much to a 30-second chart, because what I think we're doing is stretching the vertically visible volume horizontally. So we're looking much more at exhaustion. Now, of course, it depends on your time frame, if you're using automation. I would start using the default. I'd start with a 400% change in delta. I'd probably look for a sensible fixed bar period look back. Depending on the market, I can't relate to how many bars are going to form over 30 seconds or over what price range. Maybe you want to filter across 20 bars using the look back filter, and then see if that's really going to highlight where you've got volume coming in. But the challenge I see on the 30-second bar is there's not much volume to go and evaluate. Maybe the volume in this bar is more significant than the bar that happened 4 bars ago, which would be representative of running a 2-minute chart. For me, I'd much prefer to use bars that capture a decent amount of volume, because that way we can really build the picture of the history of what has been happening. Harvey now said he doesn't want to compare with only the prior bar. In that case, Harvey, slow your chart down. Your chart's too fast. If you want to see the effect over the past 2 minutes, then you need to be using a 2-minute bar, not a 30-second bar. Many people, I said this last week, they fall into the trap of thinking super fast chart gets them closer to the action. It doesn't. We have to capture enough volume in order to read the story the market's telling us. The super fast chart is just stretching this volume horizontally, and the things that we interpret as a super fast chart are much more things like divergence of delta over time. If we take a 30-second time slice, we're not really capturing enough trading information in that time slice to get anything meaningful. For many retail traders, it sounds alien. They think, the quicker I can view the market, the more information I'm seeing. Turn it on its head. Start to read volume vertically. As Peter Davis says, price does not move horizontally. Price moves vertically, and we are concerned with the volume that has traded at price. That is really a key mantra. Look at a 30-minute footprint and read the story that's there in the volume, and you'll start to see how to trade vertically. It's how traders in prop shops trading just off the dome using a volume profile. We care about volume at price. We don't care about what's happening over this arbitrary horizontal axis. Someone's asked, where can I find last week's webinar recordings? As I said at the start of this, all of our webinars are posted by the following Monday at emojitrading.com/videos, or at our Vimeo and YouTube channels, which are vimeo or youtube.com /emoji trading. So as we wrap today's webinar up, when my Commodore 64 finishes rendering the recording, it'll get posted up perhaps over the weekend, and you'll find it there. So thank you very much indeed, everybody, for attending. We've had a really good turnout today, and I'm looking forward to talking to you all next week, where we go into an advanced feature deep dive. Be prepared. Thanks, everybody. Bye for now.